Okay. Good morning and welcome to the class, and also welcome to those who join us on Zoom. Before we start, I was asked to remind everyone on Zoom that is, please turn off your mic, because if your mic is on, that there could be an echoing in the recording. So if you have a question, you can turn it on. Otherwise, please keep it off. Okay, so today we will start chapter 16, complex financial instrument. There is a lot of details in this chapter, and I posted the course outline. I posted the slides of the chapter. And I was going over it last couple of days, trying to think of a way to simplify it. And I look at those slides, there are just a lot of information on that. So I will try something new today. I will just give a quick overview without information overload. And then we will go over some examples and introduce the concepts, some of these ideas while we are solving problems. So it will be called active learning, right? And then when we finish that, we'll go back to the slide. And now with the example in our head, maybe like we can just refresh, review some of the concepts we talked about. So let's try if that's better. Okay, so a quick overview. We know what the financial instruments are, right? So we have talked about the financial instrument, and this chapter is about the complex financial instrument. So before we go to the complex ones, let's look at the basic ones. Financial instruments are basically a contract that gives between two parties, gives one party financial assets, gives other party financial liability or equity. Okay, so that's the basic idea. Now, we have been dealing with the financial instrument in a way, in a simple format. So such as accounts receivable, that's a contract. We create a liability for one party, assets for the other. Accounts payable, notes payable, shares, common shares, preferred shares, those are all financial instruments. Okay, so this chapter talk about the complex ones. So complex in what way? The first topic in this chapter is derivative. So derivatives are financial instruments that are derived from another fundamental basic financial instrument, or doesn't even have to be financial instrument. Okay, so it's a piggyback on something else. Okay, so that's called a derivative, and that's the first topic. The second one in this chapter is compound or hybrid financial instrument. So those are the ones that have more than one element, like it often has debt and equity in one financial instrument, so that you can imagine the measurement will be more complex. And two other topics are related. One is financial derivatives used as hedging. The second one is derivatives used as compensation. So that's the four main topics we're going to cover in this chapter. So today, the first will be derivatives. And we're going to talk about the three things about derivatives. First of all, just unpack what does it mean, how does it work? Because often I find if that ambiguity in accounting is resulted from the ambiguity of what's going on, right? We're recording the transaction, so understanding the transaction will be the first one. And the second one is accounting for derivatives as a financial instrument. And the last one is related to the later topic is one, the financial instrument. And the derivatives is used as hedging, the accounting for the same derivatives when it's used as a hedging instrument, the accounting can be different. So that's the three things we want to cover today. Okay, so as I said, we're going to understand derivatives, account for derivatives, and account for derivatives as a hedging instrument through examples first. So let me share an example, and I will do the same thing as we did previously. That is, I will take a note on here and I will save it, and so you can have it later on. So this is the first example, and it's in the slide. I just kind of condensed it and bring it here so we can focus just on this and, not be distracted with all the other notes. So this is an example. On January 2nd, A is the company A purchases a call option from B for $400. Okay. The option gives A the right to purchase 1,000 L shares at $100 per share. L shares are trading at $100 on January 2nd. Okay, so this example is in the slide as well. Okay, so here, call option is a derivative because call option is derived from L shares, right? So there are two things here. You have a stock, the shares of L company, which has a trading price of $100 on January 2nd. So that's one financial instrument. But this call option is piggyback on this, derived from that. So the call option allowed the holder of the option to purchase 1,000 shares of L stock at $100 per share. Okay, so many questions could arise for that. So why do I need optional? Like if I want a share, couldn't I buy it now for $100? The option give me exactly that option. So why do I need to buy it? And who would sell such a thing? So first of all, the derivatives is fairly new. I mean, compared to the stocks, accounts payables, accounts receivable notes instrument. And it has this characteristics. It can transfer the risk from one party to the other. Okay. There were in the 1980s, the derivatives all of a sudden seems that became like a worked its way into everyday average people's conscience. There was a huge story in early 1980s. There was a trader, like a trader worked for Barron Bank, the oldest England bank, and he was positioned in Singapore. He was trading. I think he was not trading derivatives, but he decided to do that. He was like called a rogue trader, and he took on so much risk, and he lost. And as a result of that, he brought the whole bank down. It was like a 150-year-old bank at that time, went bankrupt. And it was like a queen had a lot of money in that bank, and then she lost all her money in the bank as well. So it exposed how risky derivative can be. Okay, so Warren Buffett describes it as a weapon of mass destruction. It has that kind of potential. Okay, so we can have a look at why that's the case, right? But why would people deal with such a thing has so much risk? Well, usually there are two groups of people that would need a derivative. You have speculators, just they're not afraid of risk. Okay, they're willing to trade on the risk and to profit that way. So that's one side. On the other side would be company use derivatives to manage that risk. they have other business activities, that's their focus, and they do not want to be exposed to too much risk, such as interest rate risk, such as market risk, price, such as risk related to foreign currency exchange. Okay, so that kind of thing. Okay, so that's why. And so therefore, so this, everybody can buy L share on January 2nd for $100. However, this call option allowed you to purchase shares at $100 per share as long as it's not expired, right? So the L share will not stay at $100 per share. Okay, so later on in the future, L share can go up, L share can go down, right? If L share's price goes up, the option would have its value increase, right? Because with the option, you can still purchase L shares at $100. So that shows the value of the call option is dependent on the L shares value. So L share is called the underlying instrument here, and the call options value is dependent on the underlying instrument's value. Okay. So first of all, let's look at this. What's the value of the option? We have two things, right? Let's read the story first, and before we go on. On March 31st, L shares price is $120 per share, and the option is trading at $20,100. Reinforced our what we just said. The options value changes with the underlying items value, right? So when the L shares price goes up, the options value goes up. Okay. And on April 1st, A takes delivery of the L shares, while L shares are trading at 120. So that's, you start with the A, entering the contract on January 2nd, and on April 1st, the contract is closed, is executed, exercised, right? And so why would a company pays $400 for the option on January 2nd? Well, they could just purchase the share for $100. So let's have unpack this value. The value or the premium of the option. This option is a derivative, right? It's not only a derivative, but it's one type of the derivative. So what is the value? Where does this $400 come? The value of the option is $400, right? So we separate the value of a derivative into two components. One is the intrinsic value. That's a value. If you're going to use exercise now, what's the benefit? The second part is a time value. And I think by focusing on these two values, give us deeper understanding is what this option enable you to do, right? So part of it is intrinsic value. So that is basically, if you're going to exercise now, is there benefit? And that depends on the exercise price. That's the price that the call option allowed you to buy shares at, versus what do we call the spot price, the price at the moment. Okay, so in this case, if company A exercise this option right now, it can purchase 1,000 shares at $100. That's however, if without it, it's $100 anyways, right? So therefore, there's no benefit. You can just buy the shares on the open market, like everybody else, and pay $100. So there's no intrinsic value. And a lot of these instruments were constructed that way. So at the initial point, there is no difference between the spot price and the exercise price. Okay, that's quite common. But the second part is we know why people bother, because I can have the L shares at 100 price with the option later on as well, even if the price changed from that. Okay, so the difference between what you paid, the total value, and the intrinsic value is the time value. The possibility, the value of a possibility of benefit, right? So here the total value is 400, and the intrinsic value is 0. So in this case, basically company A is betting on the price of the L share will increase. Okay, as the time goes by, the L share value, if it increases, then this option would have intrinsic value. Using it will have benefit. So that's the idea. Okay, now what happens if the L share price goes down? Become $90, for instance. Good thing this is an option, right? This good thing you have a choice to use it or not, because if the L share price become $90, you will not be very smart to use the option because you have to pay $10 more per share. Okay, so as is, the option is only one type of derivative. The other type would be forward, and forward would be contract that, like, it's a firm contract on both sides. So if this is a forward, said I'm going to purchase L share for $100 per share at the date in the future, then the date in the future comes regardless what price of the L share is, you still have to purchase them. Okay, so that's the difference. Whereas the option gives the holder the choice. I can exercise when it's beneficial to me. I do not have to exercise it if it's not favorable. Okay, so that's first about that. Now, let's just go take this a little bit further. So this is the premium, the value on January 2nd. Okay, what about the intrinsic value of the option we have on March 31st? Is there intrinsic value on March 31st? What do you think? What changed from January 2nd to March 31st? L share price changed, right? Now it's $120 per share. So on March 31st, if A purchased 1,000 shares of L share at the market price, it will have to pay $120. And with the option, A's price is 100, and the option allows you to purchase 1,000 shares. So the intrinsic value is $20,000. Okay, so now things have changed. And what about the time value on March 31st? do it a little bit better. So okay, so I don't know why that's the case. Oh. So what about the time value? Time value is the difference. We're told on March 31st, the option is trading. This option the call option that allowed the holder to purchase 1,000 shares of L at $100 per share. That's a separate instrument, and that has a price value as well. So on March 31st, if you do not have the option, if you have to buy the option, this is the price you need to pay. If you have the option, you can sell your option. Okay, you can sell that. You can trade that as well, and that you will get $20,100. And then we already computed that 20,000 of that is intrinsic value. So out of the $20,100, the price of the option, about 20,000 is because the price difference on that day. If you exercise on that day, you can benefit 20,000, but it's still outstanding at this point. Okay, things could still change in the future, and the time value is a bit less, but it's still the expectation is probably L shares will continue to increase in value, right? So that's the idea. So you have $100. You were willing to pay $100 extra for this call option on March 31st. Okay. What happens on April 1st? Executed, right? So if you executed like when the price is still 120, so what happens is you will be able to buy the shares for $100 per share. Okay, so you realize the value will be 20,000, not 20,100. Make sense? And what happens basically, if you exercise when the price is 120, you sort of give up the time value. You're not going to wait anymore. I'm going to realize it right now. I'm going to use it right now, realize the intrinsic value and the potential benefit of waiting longer. I give it up. That's what it will be. Okay, so there were two things. If you look at this throughout, company A never until April 1st, the company A does not own L shares. Okay, company A did not purchase L shares, does not have L shares on its balance sheet. Okay, all it had is the option. Okay, so let's be clear. Now, sometimes in this case, the L shares was purchased on April 1st. You don't even have to ever purchase L shares. You can settle the net. You can just benefit from the change in L shares without ever having to own L shares. Okay, so let's say okay, the comparison. Say on January 1st, what's the value of 1,000 L shares? Well, I don't need to calculate it. We know it's $100,000, right? The value of the call option that gives the holder the option to purchase, to spend $100,000 is what? Is $400. Okay, so So this is unique of stock option of the derivatives. First of all, derivatives is derived from an underlying item. And here it's L shares, right? The value of a derivative depends on the value of the underlying item. So the value of the option changes along with the value of L shares. And also, in order the initial investment of derivatives is very little compared to the value of underlyings. Okay, so this is give you a glimpse. This is an option. Your risk is limited. What's the maximum risk for A? 400. That's a max, right? Like you know, if the share goes down, the worst come to worst is I can't benefit from it. I paid 400 for something which is useless. That's max. What's the maximum potential risk for B? There's no limit. You see, there's no limit, right? If the L share becomes 1,000, it will still have to deliver the shares if they choose, if A choose to exercise it at $100 per share, right? So that loss will be $900 per share. So there's a limitless. So that's why call option, the options can transfer great amount of risks. And if used wisely, can be very useful for companies to manage risk. And then, like, you know, the other participant of this transaction, the game, would be the speculators. Okay, they study risk, they take risk, and they benefit from taking risk. You know, that's hopefully. So that's the idea. Okay, so hopefully this will help us to understand how this one derivative works, and then there are two things, and how the A could be exposed to great deal potential gain loss without having to invest it a whole lot at all, right? And B here is in a position that has a potential risk. So that's first, when we understand derivatives, why people get in the derivatives, the characteristic derivatives. The second part, let's look at accounting. So I'll just copy this slide. I'll have this information we need right here, right? So accounting for derivatives. Very simple. And the review we had at the beginning of the course should help us a lot. Is basically we use fair value through net income. That's essentially what it is. It'll be recognized on the balance sheet at a fair value. And fair value through net income means every statement of financial position date, you need to adjust the value of the derivative to its fair value. So from initial purchase, initial investment, if it goes up, you recognize the gains. If it goes down, you recognize the loss. And the gains and the loss will go into income statement. So it's very straightforward. Now, I want to mention that. So this is when derivatives is not used for hedging. So derivatives is just derivatives. And when we treat derivatives without designated as a hedging instrument, fair value through net income. That's all. That's all. Okay, so let's use this principle. Okay, so that's record for company A. That's the accounting entity we focus on. Record this derivative. So I don't know the underline. So on January 2nd, okay, what is the transaction? The transaction is it purchased derivatives. So derivatives in here is derivatives can be assets or liability. And here it's an asset, right? So we can say derivatives And you can also say call option. So I will put all these in there, and the textbook keep remind us. So it is keep saying this is financial asset or liability, because he keeps using this term, like I find it was like a overdoing it, but I would just put it here. So either one of this will be good. If you just call it a call option, it's obvious it's a derivative. It's obvious it's a financial asset. It's not financial liability, but sometimes the value can go other way. So in this case, you at max reduce to 0, right? But if it's a forward contract, it can have a negative, then become liability, right? So that's all of that will be fine. So I'll put them all out there. First time, after that, I will just simplify, just call it the call option, right? So $400 and cash is paid for that. That's $400. Okay. March 31st. Now, why we bother with on March 31st? Well, we were given the information, but you know, keep in mind, we don't have to do anything unless it's a financial position, the statement of a financial position date, right? Things change all the time. Now we should know that we do not record every time something changes. It's way too much, it's not necessary. But what we do need to do is, if the company is going to report, prepare financial statements, we need to adjust everything properly. Okay, so now we can't do January 31st, there's no information. So what goes without saying is perhaps March 31st is a fiscal quarter end, right? So, right? Otherwise, you know, you don't have to do it. You can do it, there's nothing wrong with it, but like, you know, there are so many things to do, life is short, why keep yourself busy with things it's not necessary, right? So that the underlying assumption will be like there on March 31st, perhaps it's a quarter end, so we should adjust our derivative to its fair value, so the financial statement of the quarter will reflect the value of our derivatives properly. Okay, so that's it. Okay, so on that date, so what happened is the share price increased to 220. That's background information. We don't need to directly use that. Okay, we do not have share on our balance sheet. Keep that in mind. What do we have is a call option. So what's more relevant is this amount. The value of the option is $20,100. On our balance sheet, it still shows $400. So we need to make adjustments so that on our balance sheet, it will be fair value as well. So we need to increase the value, adjust the call option. What's the amount to adjust? Not 20,100, right? Like, because if we do that, it will be like too much. We'll have like more than that. So what do we need to put is the 19,700, right? So if you want to do a T account in your head, so you already have 400 there. This adjustment will debit 19,700. So the balance of your T account will be 20,100. So as I said, I'm going to, from the survey, several people said, well, this is our last required financial accounting course. Could you review a lot? And I said, well, you know, I would like to do that, but I will work it into our discussion, because like if I reviewed the 3 courses before, there would be no time left for the new contents, right? So here I will bring a little bit the difference between the level and the flow. Okay, the difference between the level and the flow. The most common mistakes from my experience is, oh, the value of call options 20,100. I know I need to adjust that. Debit call option 20,100. Okay, the 20,100 is the level. It's whatever the adjustment you make. After you make the adjustment, the balance of the option, call option, should be 20,100. Now, how much you need to change that account to reach that level? That's 19,700, because you already have 400 in there. Your tank is not totally empty. You already have something there. So to bring that level, you don't have to add the whole amount, right? So this is really important. So this 19,700 is the flow, is the change. And the difference between these two is the gain. Okay, so that needs just to be very clear. So I will call it unrealized gain on derivative. And I will be also very clear, where does this gain go? Even though it's unrealized, fair value through net income dictates that this gain has to be included in net income. Goes on income statement. Okay, so it's not whole words, but that fair value through net income, that's only like 4 letters, but it tells us a lot. We should know what to do, right? It is very clear, there's no ambiguity. This gain should be recognized first, and this gain should be included in income statement, be part of the net income. Okay, so that's that. So that's so with this adjustment on the balance sheet, we will have a call option with a value of 20,100. That's a fair value part. And in the income statement, you have unrealized gain. That's the second net income part. Any questions? Okay, without any questions, we'll move on forward. So, on April 1st, A takes delivery of L shares. So here we're talking about the settlement, right? So taking delivery is only one of the options. Okay, so even though this is A takes delivery, we will record that first, but we also going to discuss the alternative. What if A settle differently? So now we will just do that. So taking delivery means it will exercise, actually purchase the shares. So it will purchase 1,000 L shares. What do you call that? Investment, right? That'll be investment. Investment of $100,000. Now, by entering the option, you guarantee that later on, if you want to purchase that 1,000 shares before the option expires, that cost of that purchase will be 100,000. Without it, 120,000. Okay, so that's that. How much? Oh, sorry. That's fair value. Whenever we do purchase, we need to put the fair value of the shares on the on our income statement, right? So that's the option shows at this part. How much do you pay for it? 100,000. That's the part, right? 100,000. So step back a little bit. Anytime we record a transaction, a good strategy is just to put down the things that's obvious. Put down things you are sure first, and then work into the rest later. All journal entries should have the same debit and same credit, right? That helps a lot. So we know first we have shares now. And the fair value of these shares is 120,000 because shares are trading at $120 per share at the time we purchased it. However, with the option, we only need to pay $100,000. Okay. What's also clear here is now I exercised my stock option. I don't have it anymore. So I should remove that from the account. Okay, so, right? So we have a call option. How much should we remove? 19,700? 20,100, whatever it is on the account, because if we don't have the instrument anymore, it should be nothing left on the account, right? So it was initially 400. We made adjustments to bring it to the fair value on March 31st to 20,100. So it should be 20,100. That's good. And now there's a $100 difference between debit and credit. So we need to plug something here that is realized loss, right? So we talk about it, what it is represent is the time value that it still has. And by exercising it now, we give up A gives up the time value of it. Okay. So this, with this option, there is a certain benefit to A here. Well, when company enter into this stock options, right? Sometimes, like in this case, it work out that overall A company had a gain. It's a beneficial transaction. But sometimes company enters into these transactions just to minimize the risks. And by risk, we mean uncertainty. Okay, we mean uncertainty. So like by entering this contract, you know how much it's going to cost you. And that's certainty. That's good. You know, doesn't always mean you paid less. Sometimes you actually pay more. However, that certainty is important. Most business, if you think about it, you know, they are in their business. They manufacture cars, they make shoes, or they provide services, and their main source of their income is, should come from selling those products, perform services. And so these extra uncertainty they're exposed to in their normal course of operations, such as, you know, if they do business in foreign countries, foreign exchange rate comes into play. If they borrow money, the interest rate comes into play, so on and so forth. That's like, they do not want these uncertainties. They're not in the business to profit from the movement of the interest rate. They are not in the business to profit from trading foreign currencies, because that's not their main business, and they are not expert on that, right? So they treat those risk uncertainty away by entering this, okay? But in this case, it's a good thing for the company A. So overall, if you think about it, how much benefit A will manage to realize through this? Okay, what is the overall benefit for A? So it will be like the accumulated gain. No, this is not like a accounting question, but this is good, so we know what's going on. Like, you know, you cannot tell a good story if you don't know what happened, right? So that's like, it goes to accounting, is we have to understand the implication of a transaction in order to report it properly. So what's the overall gain? Well, you can look at what we recorded. You can go back to the previous slide here. We had a gain of 19,700. Okay, so we can That's the first time we actually recognize the gain, 19,700. Okay, and then there is a loss of $100 here. Okay, so the total benefit would be 19,600. Okay, so that we would just look at it through our records, right? That's clear. We can also see that intuitively. So with the option, we're paying $20 less per share when we purchase the shares. So that's like a 20,000 less than we have to pay without option. Okay, but that option, we have to pay for it. That's a $400 we pay to purchase that option. So that gives us 19,600 as well. Okay, so that's one example of that. Now, with the option, with the call option, we can easily move on to the other two format of the derivatives. So the second type of derivative is forward. So forward is very much like option. You have a contract, except neither party has a choice. So it's a firm commitment. Okay, so that's forward is like. Future is the third type of derivatives. Future is very similar to option, to forward, but the future is standardized and futures are traded. Okay, forward can be a private contract between two parties, but the future would be like you can buy futures on the stock exchange, right? So that's all the difference. And from accounting perspective, the difference between future and forward is, since it's traded on the stock exchange, sometimes the brokerage will require you to pay deposit. That's all. That's all. There's no profound difference. Just you have to pay deposit in case you end up owe a lot that the brokerage house want to have. They call the margin. Okay, so today we went through this example, and I'm not going to go on to the next sample for now. They're in the slide, but we'll go back to slide just to summarize, take what the takeaway is, right? Okay, so let me see. Okay. All right, so that's stop sharing this one. Someone participated, I did not see. Let's share the slide that I posted. Okay, so this chapter we cover derivatives, and when the derivatives is used to manage risk, that's called the hedging. That's the first topic. So today we finish most of the derivatives, but we will get into hedging next time. And the second one will be hybrid compound instrument that has both debt and equity components to it. And the third one is when the derivatives are used for compensation, stock-based compensation. So that's that. And so we talk about financial instrument is a contract, and the primary financial instruments that we're familiar with will include accounts receivable, accounts payable, notes receivable, notes payable, shares, and things like that. So the complex ones have more to it. Okay, so the first one is derivative. They derive their value from an underlying primary instrument, index, non-financial items, or commodity. So there's an underlying item that has value, and the value changes. So the derivatives is based on that. So the examples are options, forwards, futures. Now we have a detailed example of options. We do not have an example forward and future, but in theory, in concept, we know what they are. And okay, and derivatives has values, and if they are traded, the value is easy to determine. You can just go to the market. Sometimes derivatives can be if it's not traded, the value is a little bit difficult to determine. Okay, the characteristic of derivatives. Okay, the value changes in response to the underlying instrument. In our example, the call option value goes up when the underlying L shares value go up. They require little or no initial investment. In our example, the underlying value at the time is 100,000, but you can buy the derivative for $400. Okay, so that's make it accessible to lots of people or more people, and they are settled at a future date. And not only that, they can settle. Oh, we did not talk about the settle net, right? Well, if we have time, we'll go back to. They are settled in the future date. They can settle by taking delivery. They can also settle net. They can come back. So this is the example we talk about, and so we use the example to illustrate that those characteristics. Okay, who would get involved in transaction of derivatives? Speculators. They engage in transaction with the derivatives for speculative purpose, to expose a company, to increase the risks in hope of increased returns. So that's the step. For hedging purpose is to reduce existing risk. Okay, sometimes for a fee, but the risk and the loss are not the same thing, right? Yeah, risk is uncertainty, so the managing risk is just basically reduce the uncertainty. If I know for sure what's happened, that's good, give me peace of mind. That has value in that, even if I have to, it costs me, it still can be good. Okay, so some of these slides have a lot more details. I would just leave you to read them. But here, the accounting for derivatives, I'll just go to one. Basic principle is essentially fair value through net income. Derivatives are recognized on the statement of financial position on the date that contract is initiated. So if you did not have to pay to enter a derivative contract, you don't have to record it. It happens, okay? But if it has a value, you have to reflect the fair value. They are remeasured on each statement of a financial position date to their fair value, okay? And the related gains and the losses are recognized through net income. So that's like it's spelled out what fair value through net income is. Okay, so so this is the example we talk about. That you can see this recording with a lot of notes in here. Okay, with a lot of notes here. So they explain how the value may change, but on the January 2nd, this is the journal entry. That's the premium you pay, and why the components of the premium that includes intrinsic value at this point is 0, and the time value is $400. So you pay the $400 for things could change in your favor. It's pretty much for this case. March 31st, the value of the option increased to 20,100. So we need to make adjustment. This 19,700 adjustment will make the options on financial statements, on statement of financial position, to have the balance of 20,100. So there's like it's already 400 here. With the increase of 19,700, the balance is 20,100. And then we also like to unpack this. What is the value of 20,100? That's 20,000 intrinsic value, 100 time value. And this is the full. Oh, actually I have it right here, so which is great. So then when it's settled, if you take a if you take a delivery, this is the one we did, okay? If you take the delivery, you will actually purchase the shares and you will actually in possession of 1,000 shares after the exercise, and it has a fair value of 120,000, and you pay 100,000 for that, and you remove the call option, recognize the realized loss. On top here is the alternative settlement approach. Okay, so we know that there's a value in here, but you don't have to actually purchase the shares to realize that value. You can settle net. By settling net, cash settlement or settle net is basically you receive the value of that option without actually taking delivery. So on April 1st, when the share price is still 120, if you were to exercise, then there will be no time value left. So the only value left would be the intrinsic value, and that's $20,000, right? So that's like, just think it's the same for B to pay you $20. It's the same that, so you give B $100 and he gives you a share that's worth $120. That's the same thing, right? So in this case, net settlement, you get a cash settlement for the net value of the option on that day, okay, without time value in this case, right? So that's actually, this is the difference between the exercise price and the trading price on that day. In other words, that's the intrinsic value. And you surrender your option, so you recognize the same loss. So this is a net settlement or cash settlement. Okay. So that's, we recapped what we did, and actually with a little bit of extra, which showed net settlement as well. Okay. So we have a little time left, so we can go on for the additional example. Forward. So forward contract parties commit upfront to do something in the future. No options. If I said if the option is a forward, then on the certain date, settlement date, you have to purchase L share regardless of price, right? One party agrees to buy an item, that's the underlying. The other party agrees to sell the item at a specified price on a specified date. The price and the period are locked in. Okay, so we agree to do something in the future, going forward. So that's what forward is. And we both have firm commitments in that. Same thing, fair value through net income. Okay, forward measured at the present value of future cash flows discounted at a rate that reflect the risk. So that's what a fair value will reflect anyways. Generally do not trade on exchange. Terms are usually unique to the parties. So usually it's a private arrangement between banks and between parties. Bank can buy and sell these contracts. Okay, so here's the example about the forward contract. On January 2nd, company A enters into a forward contract to buy US dollars, 1,000 US dollars from Bank B for Canadian dollar, 1,150 Canadian dollars in 30 days. The spot rate is 1 US dollars equals to $1.10. Okay, so now you may kind of look at this to say, why don't you just buy now? Maybe company A does not have extra cash to buy it now. Maybe they will receive the payment before 30 days, and so they can buy US dollar then, right? So that's a possibility. Another question you will go, why? Why? One possible scenario is maybe company A had entered into contract, it need 1,000 US dollars in 30 days. Okay, it need 1,000 US dollars in 30 days. It has no US dollars, it has no Canadian dollar right now, but it will have to pay $1,000 US. It has some kind of agreement. And so by entering this contract, the advantage for company A will be enough to fulfill this obligation. You know, it will cost him exactly $1,150. There is a certainty to this situation. He knows what's going on. He needs 1,000 US dollars. It will cost him $1,150 dollars. That's it. There's no uncertainty about that. Okay, so this contract transfer the right to increase in value of underlying US dollars. The contract creates an obligation to pay a fixed amount at a specified date. So based on zero value of the forward, there's no journal entry on inception, January 2nd. Before we get into journal entry, just what happens if US dollar value rises in reference to Canadian dollars? Who will benefit?
In case of the reporting, you report a gain or loss on the foreign exchange rate.
Yes, you will gain or loss on this derivative. Yes, but if the US dollar strengthens, who benefits? A or bank? Company A or bank?
Company A.
If US dollar strengthens, without this contract, company A will have to pay more. Yeah, if US dollar weakens, then company A still have to pay the price it agreed to. So basically, in 30 days, if US dollar is more than 1.15 Canadian dollars, company A is better off. But if it's less than 1.15 Canadian dollars, bank benefits. Okay, so that's the situation, right? Make sense? Yeah, because bank have to sell A 1,000 US dollars for 1,150. That's firm commitment. And if the $1,000 worth more than that, too bad for the bank. If 1,000 US dollar worth less than 1,150, then too bad for the company A. So this situation. Okay, but at the time it's neutral. Like at the time the contract is entered, no money change hands, so there is no recording to be made. No recording to be made. And we're giving the information. This is just random. Like as I said, this I did not make this up. Came with that on January 5th. The fair value of a contract is $50. Okay, we will record it. It's not necessary. It's kind of a weird. As I said, January 5th. It's not likely to be a physical end, but that's recorded just as illustration. Okay, so for fair value, we have to record now this forward contract has a value. So this is the textbook accounts called the derivatives, financial assets, liability. Now, if you just say forward, that will be fine. Okay, it is financial asset and it can be financial liability. That should go without saying. And then we have gain or loss. So there will be gain. You can call it that. Unrealized gain on derivatives. It's more, I think, more accurate than just gain loss. Gain loss works as well. Okay, so on January 1st, take a wild guess. What happened to the exchange rate on January 5th? From January 2nd to January 5th, take a wild guess. What do you think exchange rate?
It went down.
It went down or went up?
So
Went down? And then like, would it be good for company A? So if went down, so this went down to dollar, to par. And if, how much company A need to pay to get a dollar US?
the same with that.
Exactly, right? So without this contract, it only need to pay dollar. So probably the US dollar went up. So for A, this forward contract is a good thing now. Does that make sense? Yeah, so that's it. And then on January 31st, that's a month end at least, the contract moves into a $30 loss position. So what it means is, like I find the language is like, if especially textbook, it use language like a very loosely. So sometimes interpreting question is the biggest challenge to answering the question. What does that mean on January 31st? The contract moves into $30 loss position. So it means like the previous January 5th, having that forward, the forward is valuable. It has a $50 value to company A. Now, on January 31st, the contract is not good for A anymore. Okay, the contract is good for the bank. Okay, it has a value of $30 for the bank. And one person's gain is another person's loss, right? So if there is a $30 value for the bank, there will be that value will come from the bank, from company A. So that's why the company has a loss position. In other words, on company A's balance sheet, it will have a liability of $30. Okay, liability is the level. What is the change? Where are changing from? Company A will be having to change from $50 gain position to $30 loss position. So therefore, the adjustment, the change is $80, from $50 positive to $30 negative. Does that make sense? Yeah, so the change is from $50 positive to $30 negative. So this is the change that we need to credit derivative to $80. With the debit of 50, a credit 80, the balance is 30. And so that change would result a gain or loss on derivative. It's a gain or loss. It's a loss. When you debit, it's a loss, right? So this on January 31st, A realized a loss. On the settlement date, which is February 1st, exactly 30 days later, right? The exchange rate is like a $1 is $1.05 Canadian. Okay, so if you look at a gross settlement, so that means like company actually get $1,000. So it will have US dollars 1,000. On the balance sheet, it should show in the value in Canadian, right? So it will have a cash, and this cash of 1,000 US dollar here would show up as $1,050 on the balance sheet. It's equivalent value in Canadian dollars. Okay, so that's that. And then based on the forward contract, A needs to pay 1,150. So that's the credit cash 1,150 part. And we need to remove this forward contract. The forward contract is a liability of $30 that requires us to debit that liability to remove it. So we'll debit a derivative financial asset liability. It's a liability here, $30. That will remove it. And then there's a $70 is a plug-in. The $70 is plug-in, it's the gain or loss on derivatives. So that's the taking delivery journal entry. Now, if it is settled net, cash settlement, you basically just get the value difference. So the difference is with contract, you need to pay $1.15 for each US dollar. Without contract, you need to only pay $1.05. So that's a 10 cents difference for each US dollars you're going to purchase. So the total difference is $100, right? So with the forward contract, you need to pay A needs to pay $100 more for the same 1,000 US dollars. So that's the cash part. That's the cash, the net settlement. And then the other part is the same. You remove the forward contract because it's settled, and then difference is the gain or loss. So you recognize the same gain or loss no matter how you settle it. Okay, so that's exactly when the class will end. Okay, so I will leave it right here, and I will post my note on the example on the Brightspace for today. See you Thursday.